Good morning, everybody, and welcome to our July 2026 webinar on how to conduct a climate risk assessment. And we are looking at how to conduct a climate risk and opportunity assessment today. I'm joined by Ramona Amos, who is a senior manager in our sustainability reporting team. So good morning, Ramona. Great to see you.
Good morning, Aletta. Thank you.
You can see that we are not based in the same city. I'm rugged up with my scarf, with my Nana blanket on my legs in Melbourne, and Ramona is, I suppose, sunny Brisbane today, as always. Um, BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community, and we pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. We are very excited to announce our partnership with Avarni. This has been a long time coming. We've been working with Avarni for more than 2 years, but we've now finally agreed on a partnership. So there is a link to our website where you can find out all about the partnership. It's around assurance-ready carbon accounting, and it is powered by BDO and Avarni. So BDO have not developed our own carbon accounting technology. Instead, we've decided to partner with Avarni, and therefore when we do a measurement of greenhouse gas emissions, it is our preference to work with Avarni, and you can read all about that. And now the reason that the two parties have decided to work together is, first of all, we want to provide expert guidance to our clients. So BDO's sustainability experts, we understand the greenhouse gas protocol, we understand the interplay with NGER, we understand the interplay with AASB S2. So we bring expert guidance from a technical perspective. But then Avarni has developed a really powerful carbon accounting platform. And we use that platform in particular to get complete data, reconciling carbon data back to the entity's audited general ledger. So we are working together on making that magic happen. And then for us, it's all about giving our clients that assurance, ready confidence. And when the auditors ask that first question, how did you make sure that you've got a complete carbon footprint? How did you tie it back to the general ledger? We've got it all documented and sorted. We've also outlined some of the key benefits in working with BDO and Avarni around greenhouse gas emissions. And I should say, a lot of our clients in the first year that they've reported, so Group 1 entities in their first year of reporting, have done the calculations fairly manually in Excel, but it's in that second year of reporting when you have to measure and report scope 3 emissions that it becomes more tricky and harder to do all the reconciliations. So we have a real focus on that scope 3 emissions for Group 1 entities at the moment. The other thing I should say, many of our Group 2 and 3 clients are actually adopting Avarni earlier on, even for scope 1 and 2, because Avarni has the ability to read invoices and to extract the required information to do the calculations. So that functionality is also improved. So some of the benefits, we build confidence in your emissions data to get it audit ready. It's all about streamlining the carbon accounting and reporting. So in the very first year, BDO would implement Avarni, we'll set up the rules, we'll do all the mapping to your general ledger, we'll document reasons for inclusions, exclusions, and then after that, you could potentially roll it forward and do it yourself, or you could say at a smaller or a reduced fee, just outsource it to BDO to do it every year. We look at connecting your emissions reporting with finance data and the GL. We improve Scope 3 transparency, and we want to use this holistic view of Scope 1, 2, and 3 that's complete to help you make better decisions around targets. So there's some modeling functionality to track your initiatives and what it could do to your carbon footprint. I'm so really excited about the BDO and Avarni partnership. There's a link to our website where you can read all about it. Please feel free to reach out to me or Mark Smith at BDO or Avarni. If you want to book a demo, BDO and Avarni would do the demo together because we are responsible for different parts, but we want to give you a seamless experience. I also want to share some other educational and knowledge sharing activities that we're doing at the moment. This is taking me back 18 months. About 18 months ago, we did a lot of educational and knowledge sharing activities for Group 1 entities. And now 18 months later, the focus is on Group 2. But we're also seeing a number of Group 3 entities moving early. So we've got our very popular carbon accounting masterclass. The next one is on Wednesday, the 9th of September. If you click on the green button, you can register. It's a whole day virtual masterclass where we step through Scope 1, 2, and 3, reconciling to the general ledger. We, at the end, also talk about Avarni and a short demonstration. We use our BDO Global Carbon Accounting methodology. So it's a day packed with information. Then once you've done the Carbon Accounting Masterclass, you are invited to join our alumni group. And in the alumni group, we meet every quarter. Next meeting on the 10th of August. And in those meetings, it's 2 hours and it's complimentary. We try and keep you up to date with all the latest developments around carbon accounting. So things are changing quite fast. If we hear about new developments, new applications, simplifications, we discuss it in that alumni session. Now, of course, we're also doing our monthly sustainability webinars, and this year very much the focus on Group 2. We are also doing AASB S2 masterclasses. We've done one, Ramona and I and the team. Ramona, I think it was last week, Tuesday, on the 21st of July. We did one in person in Melbourne, and we also streamed it virtually. I think it worked well. The people attending virtually also asked a number of questions. We monitored the questions very carefully. So we're going to continue with that. So on Monday, the 14th of September, we'll have our next in-person session in Melbourne, but you can join virtually. We'll also have one on Friday, the 30th of October, and then on Tuesday, the 1st of December. So we're playing around different days of the week that might suit you. It's a real crash course on how to get ready for AASB S2, talking about governance, risk management, strategy, metrics and targets, measuring carbon emissions, etc. So it's 9 o'clock till 5 o'clock in Melbourne. After this webinar, when you receive the slides and the link to the recording, included in the slides will also be the registration links. The team is frantically working on that, so we'll send that to you today. But you're also very welcome to contact me if you've got any questions or if we can help you with the registration. So we're doing these AASB S2 masterclasses with a focus on Group 2 and potentially Group 3, basically every 6 weeks until the end of the year. And we're doing it on different days to try and accommodate as many people as possible. And then, as we always do, we talk about latest developments. Now, during July, the AASB have issued another piece of educational material, and I've put in a link to that educational material. The educational material is around disclosing information about an entity's climate-related transition, including information about transition plans in accordance with AASB S2. Now, I find it a very timely publication, because what we've seen happen to date is a lot of entities in the first year have just focused on identifying risk and opportunities, um, doing a scenario analysis, getting the governance in place, um, thinking now that we've got some information about emissions, should we set targets? Should we set goals around climate related activities? Um, and obviously, before you set targets and before you publish targets, publish targets, set goals, publish goals, you want to also think about, do we have a plan to achieve those targets? Do we have a plan to achieve those goals? So often clients wouldn't disclose transition plans in their first report because they're just doing the groundwork. But now maybe when group one entities are moving into the second year, they might be ready to disclose their transition plans. So very timely guidance by the AASB. I've included in the slide some extracts from the executive summary, which I think provides a nice overview of what they're trying to achieve in this publication. So they start with climate-related risks, and we know that's where it all starts. And they say an entity might pursue a range of mitigation and adaptation responses to manage their climate-related physical risk and climate-related transition risks. So maybe in that first year, we've disclosed those climate-related risks and opportunities that could reasonably be expected to impact your financials or your prospects. But now it is, how do we respond? So do we try to mitigate? Do we try to adapt, or do we try adaptation? So mitigation efforts could be where we try and reduce greenhouse gases, and those are usually associated with transition risks. So an example of a mitigation effort, an entity might adopt new technologies or change its business model to introduce new products and services that reduce its greenhouse gas emissions. So that could be a mitigation effort. We could have adaptation responses. So usually they are primary associated with physical risks. So how do we adapt to respond to physical risks? So maybe we could, the entity might invest in changes to infrastructure to improve its resilience to physical risks, as an example. So the guidance talks about, we've identified these risks and now we think about mitigation, and we think about adaptation. They also talk about climate-related opportunities. The entity might decide, now that we've identified climate-related opportunities, we want to explore that. So an entity might develop new products and services that meet shifting consumer needs or preferences, enhance the entity's brand's reputation. So really important that we look at both risks and opportunities, because climate-related risk and opportunities are distinct, but they're not always mutually exclusive. We've often talked about this fact that they're often the flip side of the same coin. Then they go on and say, now that you've got your risks and opportunities, you start to think about strategy. And when you define your strategy, you start to think, how do we create value, and how do we generate cash flows over the short, medium, and long term? And maybe the entity should set a strategic goal that's related to climate-related risks and opportunities. So a strategic goal is a goal related to an entity's transition towards a lower carbon economy or a climate resilient economy. And in this document, they talk about a climate-related strategic goal, and they just refer to a strategic goal in general. Then it's important once you've set a strategic goal, you will consider how the entity would implement and meet this goal. So we go risks, we go opportunities, we think about strategy, we think whether we want to implement a strategic goal. And then if we've got a strategic goal, how do we implement it? So depending on that type of strategic goal, you could consider an overall approach to respond to transition and physical risk and opportunities. And in doing so, the entity's climate-related transition might cover its transition towards a lower carbon economy or a climate-resilient economy. And then in the next step, they consider and they bring it back to the purpose of this document, and that is looking at AASB S2 and transition planning. I've put in yellow because this is a key comment. AASB S2 does not require an entity to have a transition plan, nor does it require an entity to publish a transition plan if one exists. So take that in. An entity is not required to have a transition plan. And if you have a transition plan, you're not required to publish it. However, AASB S2 sets out disclosure requirements, and there are several disclosure requirements related to transition planning. And there are also requirements for an entity to provide information about its transition planning, because that information relates to climate-related risks and opportunities. Right, so as is always the concept in AASB S2, the request is to be transparent. So you don't have to have a transition plan. You don't need to have targets. But if you have a if you have targets, you have to disclose it. If you have a transition plan, you don't have to disclose the transition plan, but you do have to meet a few disclosure requirements around transition planning. So maybe that is, something to have a look at. What are those disclosure requirements? If we look at transition planning, what does the term refer to? The term typically refers to the strategic process that an entity follows to set its transition-related goals and plan its action for its transition towards a lower carbon and or climate resilient economy. So AASB S2 does not define transition planning and does not prescribe how an entity should manage its business, including the processes or policies it should follow. However, AASB S2 are intended to ensure that entities are transparent about its processes, its policies, and provide material information that is useful to the users of the general purpose reports. So transition planning, some of that information will be material information and will be required to disclose that. Remember, a transition plan as such is not mandated, and you don't have to disclose the transition plan. Some aspects might be disclosed as part of your transition planning. So if you look at a transition plan, the climate-related transition plan is the outcome of that transition planning process. And AASB S2 defines a climate-related transition plan as an aspect of an entity's overall strategy that lays out the entity's targets, actions, or resources for its transition towards a lower carbon economy, including actions such as reducing its greenhouse gas emissions. So that detailed transition plan would form part of the entity's overall strategy. It's just one part of the overall strategy of the entity, and it's a transition plan focusing on climate-related risk and opportunities. That whole transition plan and that whole document don't have to be published, but certain extracts as it links to risk and opportunities would make its way into the AASB S2 compliant report. Then I've included the extract And then they also say entities that have decided to develop a transition plan might be at different stages. Some people haven't started. Some people have done their first compliant report and now they're putting their mind to this. And maybe some people have already developed it and they continue to update it from time to time. I want to point you to the last paragraph on this slide where it says an entity that has developed a transition plan might decide to publish it voluntarily, for example, to meet investor expectations or to meet legal or regulatory requirements. It's not mandated by AASB S2 to publish, but you might voluntarily decide to publish it, or maybe you receive some questions from various investors and you decide to share it with them. Alternatively, an entity might not publish that plan, but instead develop it for management information purposes only. So there could be different uses for this transition plan. Going back, the AASB then goes on and talks extensively about transition planning, about transition plans, about disclosure requirements, linking it to risks and opportunities. So very useful guide that we want to flag with you today. I also want to talk about our best practice methodology. Now, at the moment, I think most of the time, Ramona, we are focused on this best practice methodology. To be very transparent, about 18 months or 2 years ago, when we started to get Group 1 entities ready, we developed a methodology and a roadmap. And now that all those Group 1 entities have reported, and Ramona and I have, and our team have been subject to assurance by other firms, but also we have been part of BDO's audit assurance, sustainability assurance teams. We've learned a few things and we've decided to tweak our best practice methodology. Now, there's two tweaks. The first one is when you look at projects 8, 9, and 10, for clarity purposes, we've decided to break them down into an 8A and an 8B because there's two fairly significant things that happen in those projects. And we wanted to flag that separately, and they have their own separate deliverables. So you'll see an 8A, 8B, 9A, 9B, 10A, 10B. That's the first change we've made. The second change we've made is we've switched over projects 8 and 9. So we used to do project 7, climate risk and opportunity assessment, and then we went straight into scenario analysis. However, we've learned over the journey that after you've done a risk and opportunity assessment, it's really important to go from the long list of risks to the short list of risk in the prospects assessment. And then for the rest of the projects onwards, you just focus on those risks and opportunities that have survived the prospects assessment and are now the short list of risks and opportunities. So those are the two changes we've made, but I think they're significant improvements and would provide a lot of clarity. When you come to our AASB S2 masterclass, virtual or in person, we step through all the projects highlighted in green, because those are all the projects that's required for the very first year of reporting. And then we don't focus on scope 3 in particular, because that's dealt with in great detail in the carbon accounting masterclass. If you want to go a bit slower over carbon accounting concepts, it's better to do the carbon accounting masterclass. We do it very fast in the AASB S2 masterclass, just for completeness and more a matter of revision. We also in practice often do these two project streams at the same time. So usually we have two different directors in our team leading two different teams doing the two parts. Just this morning, Ramona and I met with a new client where we set up one director, Mark Smith, usually looks at greenhouse gas emissions and that measurement, he and his team. And then Ramona and Helena and their team look at the second stream around carbon, around climate, conducting a climate risk assessment, opportunity assessment, a scenario analysis. So we do it at the same time to get to the answer fairly fast. Ramona, I'll finish my coffee and give you an opportunity to talk about Project 7, which is conduct a climate risk and opportunity assessment. Now, this ties back to what we've done over the last few months. We've talked in a webinar about climate policy, and the climate science. Last month, we talked about climate risk and opportunities, TCFD guidance around categories. So this is now kind of rounding it out. How do we conduct a climate risk and opportunity assessment?
Thanks, Violetta. So I think initially today it will be worthwhile just to recap on the different categories of climate-related risks and opportunities. Won't go into these in too much detail. The last month's webinar recording is available on the website, but just to give an overview, so the TCFD provides a categorization of climate-related risks split into two different categories, physical risks and also transition risks. So the transition risks are then split into acute and chronic physical risks, so acute being the weather-driven events and chronic referring to those longer-term changes in weather patterns. Transition risks are then split into four different groups, so policy and legal. So as we mentioned, the climate policy, really quite important and underlying different, driving different climate-related risks. So looking at policy actions and also legal risks. Technology, another category, so developments in technology to address climate. Market risks that could be related to how your competitors are operating, your customers, customer preferences, those sorts of things, and then reputation risks as well. The other categorization that the TCFD provides is the climate-related opportunities. And so some categories that TCFD provides, I should know these off by heart, but on the spot. Resource efficiency, so where you can reduce costs but also emissions, energy source opportunities, potentially changing to lower emission or renewable energy sources, products and services as was discussed in the transition plan, so looking at different products and services to meet shifts in consumer preferences to those different products and services, but then also potentially addressing a climate-related market risk where customers are moving away from a particular product. The market opportunity, so this specifically referring to new markets such as in developing countries and looking to diversify income, but other market opportunities as well. Again, this one very closely linked to the market risks that you've identified. And then resilience, looking at an entity's response to the risks and opportunities and their ability to, for an example, reopen after major flooding, but also just an overarching ability to respond to the risks and opportunities that are impacting that organisation. So these are the categories that you need to consider when you're conducting a risk and opportunity assessment. As we spoke in much more detail in our last webinar, the risks and opportunities are really driven by climate science and climate policy. And so when conducting a climate risk and opportunity assessment, we spoke about some different sources of research, sources that you could use to research and assess identify but also assess the impact of physical risks on your organization. So changes in weather patterns, changes in vulnerability and exposure to flooding and different types of weather events. Then on the other hand, there's the climate policy that's really driving climate risk. So again, in identifying but also assessing climate-related risks and opportunities for an organisation, having an awareness and understanding of climate policy, not only in the region that you're operating in, but regions and jurisdictions that are relevant throughout your value chain. So that may be key suppliers, key customers, but also, from using a terminology from the greenhouse gas protocol, from cradle to grave, so all the way through your value chain, from initial raw materials through to disposal. So in considering climate policy and identifying the climate related risks and opportunities across all of those different categories that TCFD provides, having an understanding of that climate policy and climate science provides a basis and a foundation to then explore those different categories further. So at this point, I think it's worthwhile just reminding, we've covered different sections of the report throughout the webinars, but this closely links with the risk management disclosures and the requirement to disclose the inputs and parameters that you have used in the process for identifying risks and opportunities. So talking about a requirement to disclose, for example, data sources. So when you're looking at climate science, that might be some of the sources that we provided in the last webinar, but climate policy, the sources, so government sources and the like for climate policy in those jurisdictions. Also a requirement to disclose whether and how you've used scenario analysis. So once again, looking at those different sources for climate science, the IPCC and also Australian sources, for instance, often provide different scenarios that you can use to assess what weather patterns may be in the longer term. So quite often the medium to long term exposure is greater. So looking at those different scenarios and how those risks might behave and impact your organization in those different scenarios. So in conducting your risk and opportunity assessment, documenting and considering those sources then helps to inform and feeds into those disclosures in the risk and in the risk management section of the report. Just also to point out this, and is sometimes overlooked, that same information is required for opportunities specifically. So make sure when you're conducting your assessment that you're considering that aspect as well when looking at climate science and policy, but also conducting research around the different categories and how that impacts your organisation. So then moving on to the next slide, when you have gone through a process of research and speaking to different stakeholders in and outside your organization, generally we then move on to, or then we generate a quite long list of potential risks and opportunities that we would then consider and assess. So in conducting the risk and opportunity assessment, once you have this long list of risks, there needs to be a process similar to enterprise risk management processes where there is an assessment of inherent risk. So the risk to the organization before you have any controls in place, and an assessment of the likelihood of consequence. You then move on to, and so generally we would document this in a risk register and have this assessment documented there. You then move on to identifying controls, and again, this can be require the involvement of many different stakeholders within the organization to identify controls that are in place to manage that risk, to then flow on to determine what the residual risk is. So once again, linking back with the risk management disclosures, there's a requirement to disclose how you assess the likelihood and magnitude of the risks. So this would be the process that you've gone through, and also quite often in the disclosures, if we move to the next slide, Aletta, entities will have as part of their risk management framework a definition of risks and likelihood that they apply in making that assessment of inherent and also residual risks. So from a likelihood perspective, just an example, but the definitions are almost necessary in able to make those assessments. Quite often you'll see likelihood ratings ranging from almost certain to rare, with unlikely, possible, unlikely considered in that likelihood rating. Then from an impact perspective, and again this depends on the the nature of the organisation and the maturity of their risk management processes, but quite often a number of different factors that are considered, particularly in relation to the impact or consequence of the different risks. So once again, this needs to be assessed at an inherent level as well as a residual level once controls are considered. And so different levels of rating and different factors, whether they be financial or operational and reputational. And once again, linking back to the disclosure requirements in the risk management section of AASB S2, there's a requirement to disclose whether you consider qualitative and or quantitative thresholds in this process. So this would be a way to document and demonstrate what's considered for an organisation. Just onto the next slide as well. So the once these ratings have been determined, or part of the process of determining these ratings and then including them in a risk register, we would then generally apply a risk matrix. So again, just an example provided on the screen here, where the likelihood and impact or consequence ratings are combined to determine what the overall risk rating is for an organisation. I think as we're moving through to the prospects assessment, and Aletta will probably reiterate this point when we get there, is really important to have this assessment and risk rating at an inherent and a residual level in order to determine which risks and opportunities meet the or go through the process or the culling process that you undertake in the prospects assessment. It is both inherent and residual, as well as information about your controls that need to be considered when conducting the prospects assessment. So just wanted to make that point quite clear, that both of those are quite important, and having this risk matrix to help with that process is also quite important as well. So I think moving through, this is an example of a risk register. So generally, we would have a name for a risk, each risk for the long list of risks, but then also a description, and the categorization can also help as well. So referring back to those different risks from the TCFD categories, having that categorization in the risk register can just help to group and inform those risks, but there's no requirement to actually disclose the different categories. As we've said, sometimes they're quite don't necessarily fit neatly into one box, but we do find it useful when conducting the risk assessment and putting the register together to keep a record of those categories in that process. A risk owner it's again dependent on the organization, but can be very useful in order to determine who's responsible, which then feeds back into the governance disclosures as well. And then also as far as documenting controls and overall responsibility for determining what the inherent and residual risk ratings are. This register also has an action plan to the side that then could be feeding into that transition plan that Aletta was discussing earlier. So I think then we have just some other examples of matrices and different likelihood and consequence definitions. As we're moving into group 2 and group 3 reporters, sometimes these risk management frameworks and policies aren't in place and documented. So these types of definitions and descriptions to enable you to, again, categorize and assess when you're working through the process of rating climate-related risks and opportunities. I also reminds me of another point. Working through this process, rating risks is something that a lot of organizations are quite familiar with, but we've also found that applying similar definitions can be applied to opportunities as well. And so as you're working through the process, you may have a long list of opportunities, and to use a similar process and definition to apply that to opportunities is very useful information to then inform the prospects assessment and the disclosures, and have all of that information in the same place as part of your documentation for working towards disclosing the risks and opportunities in accordance with AASB S2. Moving on, controls, and again, this is just an example, but some organizations and their framework will rate their controls or their control environment, and the residual risk rating becomes almost a formula and a function of assessing the inherent risk and applying, once the controls are documented, assessing the effectiveness of those controls to then determine what the residual risk is. So again, just an example of a control definition for a risk management framework and a residual risk as well. So in practice, the sophistication of the risk management framework and the definition of inherent risk, controls, documentation, and also residual risk varies quite widely. So again, AASB S2 doesn't dictate how you assess risks, but requests or disclosure of information about that process. So this is some of the information that can inform those disclosures. So I think as far as the conducting the climate risk assessment, we spoke in much more detail last week about different types of risks and opportunities that could be identified throughout the process. The way that we approach a climate related risk and opportunity assessment is to conduct a lot of research, talk to internal stakeholders, gather information from various parts of the organisation, and then document the process that we have gone through, including all of the research that we have conducted, and that may be academic sources, government sources, news articles, or internal information that an organisation has, to arrive at this long list of risks and opportunities that is the research and the thinking behind that is all documented in quite a lengthy report. So that's how we approach that task, and combined with that, the risk and opportunity register with the ratings at an inherent and residual level, as well as documentation of controls, and in most cases a risk owner as well, as part of the documentation of the process, and working the way through it.
Thank you very much, Ramona. I'm just looking at this extract, which was taken from one of our reports. And I look at references, the second last item on the table of contents, and I can see there the references start on page 55. And it goes for 4 pages. That's a short list of references, I suppose. But, you know, we have real academic references. We do proper referencing so that we can support every statement, suggestion when the auditors come around. And I think that's a very valuable part. If we look at the climate risk and opportunity assessment, when we are working with our BDO auditors, if there are not references, you know, how do we know where the information comes from? So references or sources are actually incredibly important as part of this process. All right, thank you, Ramona. If we then go on to Project 8A, now in the past, we've kind of done it at the end of Project 7, part of Project 7, and now we've called it out separately. And we call it Project 8A, a prospects assessment. We've called it out separately in our best practice methodology because in our experience, auditors or assurance providers place a lot of emphasis on this prospects assessment. If you give the auditors your long list of risk and opportunities, they want to know the thought process that's gone through culling that to come up with a short list of risk and opportunities that end up in your AASB S2 report. So documenting that process is incredibly important. So why do we call it a prospects assessment? Be very clear, it's not a materiality assessment. We don't do a materiality assessment in AASB S2. We do a prospects assessment in Project 8A, and in Project 10A, we look at material information, but never do we look at a materiality assessment. So the objective of AASB S2 is to require an entity to disclose information about climate-related risks and opportunities that is useful to primary users of general purpose financial reports in making decisions relating to providing resources to the entity. We know that in AASB S2, when they look at the objective, the key words, we are looking at disclosing information about climate-related risk and opportunities that could reasonably be expected to affect the entity's cash flows, access to finance, cost of capital over the short, medium, or long term. And that 3 bullet points, cash flows, access to finance, or cost of capital, are used in the standard with the phrase prospects. So really, if you cut the first bullet point down, it reads, we have to disclose the risks and opportunities that could reasonably be expected to affect the entity's prospects. So whenever you see the word prospects, we think cash flows, access to finance, cost of capital. We look at risks and opportunities that could impact the prospects. And if those risks and opportunities could not reasonably be expected to affect the entity's prospects, they are outside AASB S2. And remember, AASB S2 is all about disclosure. So it might still be a risk and opportunity that have to be monitored on an ongoing basis, but you don't have to disclose it to the wide world in a mandatory sustainability report. In order to support that as well, I think paragraph 9 is a critically important paragraph because it says an entity shall disclose information to enable users of general purpose financial reports to understand 5 key things. First of all, the risks and opportunities that could reasonably be expected to affect the entity's prospects. So that's kind of an introduction. We look at climate-related risk and opportunities that could reasonably be expected to affect the entity's prospects. And now I've highlighted in green in subparagraphs B to E, then the disclosures are focusing on those climate-related risks and opportunities. So which really means you don't have to disclose the long list of risk and opportunities. You cut them down in terms of paragraph 9A, and then for the rest of the disclosures, you only focus on those risks and opportunities identified in paragraph 9A. So you are going to look at current and anticipated effects, and you are looking at business model and value chain. You're going to look at the effects of those short list of risk on the entity's strategy, decision making, and also include information, certain information about the transition plan. As the AASB educational material says, you don't have to disclose the transition plan, but some information. And subparagraph D, we look at the effects of those risks and opportunities on the financial position, financial performance, cash flows for the period, for future period. And then we also look at climate resilience in paragraph 9E. And this is where we are looking at scenario analysis to assess climate resilience. And again, we're only looking at those identified risks and opportunities. So really what we're doing is after project 7, after we've conducted our climate risk and opportunity assessment, we come up with a long list of potential climate-related risk and opportunities that end up in a risk register that might be monitored on an ongoing basis. Absolutely. However, for disclosure purposes, we do a prospects assessment, we cut the long list down to a short list of those climate-related risks and opportunities that can reasonably be expected to impact the prospects of the entity. And those are the risks and opportunities that will be disclosed. And those are the risks and opportunities that we put through projects 8B to 10B. If you look at a prospects assessment, you might ask, so what do we do? So here we are evaluating these risks and opportunities against some materiality indicators. So the considerations, we will look at inherent risk. So we'll look at is the risk exposure, the consequence, or the likelihood rating elevated? Why is it elevated? Let's understand the inherent risk. Is the risk maybe concentrated? And should we combine with other risk? We look at residual risk, so the risk after control. So really, you're looking at residual risk because you want to get a sense of the effectiveness of controls, but you also want to consider potential future strategies and initiatives and key dependencies. You want to consider planned control strategies and initiatives. So it's not just the residual risk, but also what are we going to do about this residual risk? I just want to make it very clear. We are not looking just at residual risk. We are looking at both inherent risk and residual risk because we are ultimately looking at a market perspective. What would the market expect to be a risk and opportunity for the entity? And the market will look at an inherent risk because they don't know about your specific controls. We also consider financial impact. So you don't have to quantify it at this stage. This is just a qualitative consideration of potential financial impact. So examples are we would think about cost of controls. So current or actual costs, anticipated or potential cost of planned or possible controls. We look at risk occurrence. So we look at the cost incurred during the reporting period because this risk actually realized we had a flood, we had a cyclone. Then we also look at anticipated risk occurrence. So some historical indicators or previous events and how that would inform our forecast exposure. So if we know that in the past, if our stores had to close down, we know that there was loss of revenue of a certain amount. It could have been for another reason that the store closed. But we have some historical data that we could apply and say, if our stores will close in future due to a climate-related event, we know what the loss would be. So it's important to consider historical things that happened and how we could potentially use that in anticipated risk exposures around financial impact. We look at risk velocity. So that would be the forecast trend based on management's current assessment, how often this is going to happen. Remember, the prospects assessment is looking at our current assessment, our current business model. And we're also looking at some behavior between the time horizons. Is there a moderate risk today that might be increasing over time? Or will it stay the same or will it decrease? Very important in the last aspect, we look at industry or peer disclosures. So what are common risks that are disclosed across the client industry? We don't have to pick up everything. There might be valid reasons it doesn't apply to us, or maybe we've identified risk that the industry haven't applied. We have all in the industry have different suppliers, different customers. Although we may be in the same industry, we have different location of operations, for example. We've got different value chains. Then we also look at specific decisions where we've decided not to pursue certain opportunities or not to address certain risks, where in the rest of the industry they are looking at it. Let's think whether that was a good idea. We look at value chain impacts upstream and downstream. But ultimately, after we've considered all of this, for each individual risk and opportunity, We want to reach a conclusion whether a risk and an opportunity could reasonably be expected to impact the entity's prospects. One of the errors we've seen is that entities have done a prospects assessment across risks, but not across opportunities. So just as an example, again, an extract of how we would do it, usually in Excel, we would have our risk name, risk description. We delete all the other columns in the risk register. We just work with the inherent risk rating and the residual risk rating. So all of the information in yellow there comes from the risk register. You don't have to create new information. And then we do an assessment. So the mustardy color, we look at a description of current and anticipated financial impact. Then we look at what are primary user expectations, industry expectations, and then we also look at any other considerations we think should impact this prospects assessment. And finally, on the right-hand side, we conclude whether this risk could reasonably be expected to impact the entity's prospects. Sometimes we also in that column decide to combine a few risks, aggregate a few risks for disclosure purposes. Very important prospects assessment. I'll hand over to you for some disclosure requirements on these risks that pass the prospects assessment.
Thanks, Aletta. So we thought just at this stage it would be good just to reiterate the disclosure requirements specifically, and Aletta mentioned before, that first paragraph, the key paragraph around 9A. So as you're working through the process of conducting the risk and opportunity assessment, worthwhile to keep in mind what the disclosure requirements are coming out of that. So as Aletta mentioned before, for paragraph 9A, there's a requirement to disclose information to help users understand the risks and opportunities that could reasonably be expected to affect the entity's prospects. So you need to disclose the risk, but then also a description of how that could affect the entity's prospects. You need to explain the risks and opportunities that you've identified and identify whether or not they are a physical or transition risk. You also need to specify whether over which time horizons they're expected to affect the entity. So the short, medium, and long term needs to be defined in AASB S2, and then you need to disclose which time horizons you expect the impacts to occur. The next disclosure requirements, so as I said, you need to define whether it's define what short, medium, and long term is for the organization. It's not, AASB S2 doesn't tell you what those time horizons might be, but you do need to explain how those time horizons that you've defined link to your planning horizons. So generally, you would align the definitions of short, medium, and long term to your planning cycles or strategy cycles, and then explain in the disclosures what that link is.
Thank you very much, Ramona. I've also included some slides which are learnings from year one. In our May webinar, we talked about the fact that we've reviewed a large number of reports that were lodged with ASIC for 31 December 2025. And I went back to those and I tried to extract some of the common climate-related risks that we've seen in those reports, but also the common transition risks that we've seen. Now, I thought I'll have time to step through all of this, Ramona, but I'm always overly ambitious with the webinar. So I might just include it here for people to have a look at. If you want to look what were the most common extreme weather events that were actually included in reports lodged with ASIC, also some extreme heat or temperature rise risks that's been disclosed. I think it's interesting to have a look at what people are considering. We've got some water-related risks, supply chain disruption, and infrastructure damage. So there's a large number of suggestions and ideas of climate-related physical risks. We've got a bit of an overview. The majority of entities disclosed acute physical risks, so extreme weather events, as their primary physical climate concern. And then the three most common risk types across all industries were flooding, extreme heat, and storms. We've done a bit of an analysis. Obviously, it's not a huge cohort that we've reviewed. I think we looked at 67 reports, but across the industries, these were some of the specific physical risks that we've seen. Um, we've also looked at climate-related transition risks, and we've identified a number of risks that's been disclosed, again, to try and give you food for thought, things to consider, things to think about. So these are an overview of some of the key policy, regulatory, and legal risks that various organizations reported. Some ideas about market risk and demand risk, customer risk, a bit of an overview on the technology risks that we've seen in those reports. A number of people talked about energy cost and supply risk. There were also reputational risk, or other people framed it as social license risks, um, financial and capital access risks, supply chain risks, and human capital and capability risks. So a bit of an overview of climate-related opportunities. I don't have a breakdown of this, but I thought some of the most common opportunities relate to energy transition product demand, low carbon fuels or products, operational efficiency improvements. You can see that many entities in mining and resources see opportunity in critical minerals, a demand for electrification. Energy companies focus on low carbon liquid fuels and renewable hydrogen. Um, Several entities identified cost savings through energy efficiency and fleet electrification. Many infrastructure companies see opportunities in expanding capacity and diversifying services for a low carbon economy. And a significant number of entities disclosed no material climate related opportunities. And in our experience, usually there are opportunities. It's a lot of risk have a flip side of an opportunity. So that was also quite interesting as part of our analysis. So finally, thank you very much for joining us today. Next month, Ramona, we go to our favorite topic, scenario analysis, which is a beast. So how BDO can help. We've got our regular corporate reporting insights published last week, Thursday. It had 19 articles in, and sustainability was, I think, the majority. Sustainability news will be published today. We have a climate-related disclosure checklist. We've got an illustrative sustainability report, and we also have a checklist for boards. I'm continuing to do a lot of sessions with boards, and they always ask me, what questions should they ask management and executive before they sign off on the mandatory sustainability report? So next month in August, Ramona and I will look at scenario analysis. Just again, a recap that our AASB S2 masterclasses will be running September, October, December, every 6 weeks. We'll send the registration links after this webinar, but you can also reach out to me. We've got carbon accounting masterclasses. We've got alumni events, so a lot of opportunities to learn. And we also have the online or the on-the-go learning on your mobile phone. Please reach out if we can help you with any of these services. We would love to speak to you. We would love to help you. Thank you very much for joining us today. Thank you, Ramona, for presenting with me, and we'll see you next month.